To help you with this question, let's work through the calculations together. Now, it's very important that you identify the dates in this question. You're specifically told that the year-end date is 31st of December 20X7, and the acquisition took place on the 1st of September 20X7. Okay, so in this example, Fawn Co. purchased Neutral Co. on the 1st of September 20X7, which was during the year. Now, whenever we calculate goodwill, we always calculate goodwill at the date of acquisition, which means you are going to need to know what the net assets of this subsidiary was at the date of acquisition. We can work this out using the information in the question, okay? But firstly, we know that the goodwill calculation starts with the consideration, okay? And the consideration has been given to us in this question as 3.4 million. We then need to add the NCI at acquisition, okay? And again, this is given to us in the question as 600,000. Now, the more challenging step here is working out what the net assets at acquisition are, okay? The net assets at acquisition is going to be a working that we're going to calculate just underneath. So net assets at acquisition, we're going to do a little working, okay? Now, net assets are the same as your equity, okay? So the ordinary share capital and the retained earnings. But the key thing is it's got to be at acquisition. So how do we work this out? Well, we know that the share capital of the subsidiary is given in the question as 500,000, okay? That is 500,000 on December X6 and December X7, which means it hasn't changed, okay? And for the purpose of your exam, you're not going to see changes to that, so share capital will remain constant. We've then got the retained earnings that we need to calculate at acquisition. But notice the acquisition date is the 1st of September. We do not have that information. However, we can calculate this because what we do know is what the retained earnings were at the start of the year, 1.8 million, and we know what they were at the end of the year, 2.4 million. We know that retained earnings are simply an accumulation of all the profits and losses that have been generated by the business. So what we can do here is we can take the brought forward retained earnings, okay, so we're going to say brought forward retained earnings, and that's given in the question as 1.8 million. And to this number, we're going to add the profit for the first 8 months of the year. Okay, why is it 8 months of the year? Well, the reason it's 8 months of the year, it's because you have acquired, well, you see in this question that the parent has acquired the subsidiary on the 1st of September, which is 8 months into the year. So if you calculate the profits for those first 8 months and you add it to the retained earnings brought forward, you're able to identify the retained earnings on the 1st of September. Okay, so we're going to take the profits for 8 months of the year. Now, how do you get the profits? This isn't given. Well, actually, if you know what the retained earnings are at the start and beginning, so we know at the end of the year it's 2.4 million, and we take away the 1.8 million, what that's going to give us is the profit for the full year. Okay, if we then multiply that by 8 months of the year, so 8 over 12, what that's going to give us is 400,000. Okay, and therefore we now know that the retained earnings at acquisition is a combination of the 1.4 million plus the 400,000, which gives us 2,200,000 or 2.2 million. Okay, so now if we know what the share capital is and we know what the retained earnings at acquisition are, a combination of those two numbers gives us the 2.7 million. Okay, and if we deduct the net assets from the calculation, okay, so if I just go back, we've got the consideration of 3.4 million, the NCI 600,000, net assets of 2.7 million. We cast down, what we're going to get is 1.3 million as our goodwill. Okay, so the key thing to realize here is that you were trying to work out the retained earnings at acquisition, which were not provided. So the way to work that out was to take the retained earnings at the start of the year and then pro rata the profit 8 months of the year to add it on to the brought forward retained earnings. And in order to get the profit for the year, you were simply taking the difference between the opening and the closing retained earnings and multiplying that by 8 months. I hope that helps.